What's up, investors? It's the Russian Dude, and welcome to another episode of the Communistic Capitalism. And oh my, some stocks fell as much as 40-60% from their all-time highs. And some companies, they fell literally 40% in one single day, which is today. And I'll be showing you exactly which two companies, at least these are the two companies which I found. And these are the companies that at least people somehow heard about them. And okay, so Jamie says that today has been awful for my cortisol. Let's talk about how things are gonna get worse and laugh about it. Exactly. Because these live streams, they're always about the worst case scenarios, but we never get pessimistic. We never feel bad about this because corrections, recessions, all these kind of things are inevitable. There is not a single chance, not in a million years, that the stock market can go up every single day for, I would say, more than 2 months straight. There will be corrections, there will be 1% corrections, 2, 5, 10% corrections, but they will always happen. One correction will be stronger than the other. Some corrections will be insignificant. Some corrections will be you do not even know about these corrections. For example, like the majority of the stock market is falling, like it is happening right now, and I will show you with all the proof and facts that right now 83% of companies are falling, and the rest 17% of the companies, these are the companies that bring the Nasdaq, the S&P 500, or basically the whole stock market in general combined. These are the companies that make it look like that nothing is happening yet. And this is one of the major theses that I have during this live stream. It is that even though all these financial investing, stock picking YouTubers, who obviously, I'm 100% telling you, if you go see Kit Mevin, Nom Tash, all these like stock screaming gurus, who are like, buy this is the next $1 trillion company, and at the same time they're making videos, the problem with stock picking videos, and at the same time they're once again making these kind of videos. So I'm sure these people, they always buy at the very bottom and they always sell at the very top. At least this is what they tell their viewers. They always sell before the correction, before the crash, and they always buy, like whole entire their portfolio was bought when the market price was the lowest possible price. Sometimes, so it may look like they're regular people just like us. Sometimes they say, oh yeah, I made a mistake, I lost like 1% in this company, but don't worry, the rest 99% of my portfolio is up 2 million %. So just go buy my course, subscribe to my Patreon and all this kind of stuff. Don't worry. Corrections, recessions, these things happen. There's nothing we can do about this. We are all still young. We need to buy during such corrections, recessions. And I did buy 3 brand new companies for my portfolio today. But because today I just bought it, so I did not have time to put a, let's say so, presentation about these companies. So next week, unless something significant else happens, next week I can talk about which 3 new companies I bought for my portfolio. But today, let's focus once again why I think, even though today and last Friday specifically were very red days, so these 2 weeks were pretty bad, let's say so. Even though if you are well diversified investor, if you have value stocks, maybe some of you even have bonds, equity, commodities, gold, whatever, maybe you did not experience that much decline. But if you follow the advice of all these YouTubers, if your portfolio is like 50% Tesla, 40% Palantir, 10%, I don't know, SoFi or whatever, like yes, unfortunately during these couple of weeks, your portfolio lost 10-20%. And there is no way you can lie about this. Like those people who actually follow these YouTubers closely, they know that all they're saying it is a BS, big load crap of BS. Unfortunately, this is what it is, but let's go into the topic because once again, I want to make a short live stream. Today I want to be over like 15 minutes. I only have like 15 minutes left. So let's focus on what we need to talk about. And as always, never live stream goes without a big, nice, cold jar of beer. So, salute, cheers, na zdоровье, let's get into it. That's a good one. Okay, so let me put I don't even know in which order to talk, so let's just keep going as it is. Okay, so one of the first things that we were talking about previously in previous live stream, basically almost every single live stream I was talking about previously, but okay, now I need to disable my ad block so you can actually see the stuff. So annoying. Okay, excuse me, sorry about that. Canadians always say sorry. So, tapering and all these kind of things. Tapering is in two-phase. Very brief summary for those of people who may be just for the first time joining this live stream, or for those people who will be watching this live stream later. Tapering is a two-phase thing. First, basically they need to reduce the asset purchases, which is basically treasuries and mortgage-backed securities, which is in simple terms, it means to reduce the money printing. Originally it was $120 billion per month. Now previously they were thinking about decreasing by 15 billions per month, and now they're thinking about decreasing by 30 billions per month. And the second stage is to increase the interest rates, which basically, as soon as all these two things happen, instead of quantitative easing, whatever was happening in the past, now it's going to be quantitative tightening. And so right now, people think, analysts, me including, think that as soon as the interest rates go up, and if these interest rates go up significantly, this can create a chain reaction of uncontrollable events and crashes and bankruptcies, defaults and all these kind of things. And this is where the Federal Reserve needs to be extremely careful. But right now they're saying, Powell says Fed will discuss speeding up buying taper at December meeting, which once again, I couldn't find right now because I didn't have too much time to prepare. I was even late for this live stream, which once again, sorry about that. But they will increase they will accelerate, they will shut down the money printer faster by reducing the asset purchases once again from 15 to 30 billions. So theoretically, it needs to take 4 months to just stop the money printing. After this, it's gonna be interest rates. But because right now economy is correcting itself, stock market is correcting itself, all these new variants and all these kind of things, so people are afraid, and right now might not be the best time to do all this quantitative tightening. But unfortunately they have to do it because there is so much money. The inflation is 6.2%, and this is just the official number, which means that unofficial number can be higher than this. We just don't see it. Obviously, we might feel it, but we don't see it, at least nowhere in the news. So, and after they stop the money printer, which once again is supposed to be happening in 4 months, they need to increase the interest rates as soon as possible. And because right now we are doing the corrections do not usually last 1 week. They can last several months. So what if, when the market is going to be at the very bottom and they have to increase the interest rates, this will trigger even worse correction, recession, possibly even stagflation. So this is the first thing. The next thing, let's see what interesting we have. Okay, so let's talk about this favorite stocks. Okay, these are cool kids stocks. As you can see, unfortunately I did not have too much time to prepare sophisticated presentation today, but it's basically all understandable, and at least you can see it. My portrait in the bottom right does not cover all the data. So these are the cool kids stocks, all Pelotons, Palantirs, like all this, not just a car company, not just a bike company, not just this, not just that. These are just this type of companies. No matter, like, people wanted to say that Peloton is gonna be $1 trillion company because wow, it's so innovative. They combined the bike and iPad, and now you can exercise while watching some exercises on your iPad. Come on, you can just take your iPad, you can turn on the TV and start biking on a regular bike. Yes, they made it more convenient, but there is nothing extremely innovative for this company to be like, I don't know, $100 billion company. So that's it, the correction, logical thing happened. Peloton went more than 50% from its all-time highs. Right now I think it's even less than this, even worse than this. Other companies, Roku, like, come on, it's just this small USB type, HDMI type of device that makes any TV to be smart TV. Or if you have already smart TV, this is what gives you like Netflix, Hulu, all these kind of things in one place. So like, yeah, it's cool idea, but there's like Amazon Fire Stick. There is I forgot the name, but there's so many different things. You can do it from your PS, from your Xbox. You can just use your laptop after all. So yes, it is kind of convenient, but there is nothing innovative for this company to be $1 trillion company. DraftKings, Robinhood, Zoom, Alibaba, Palantir, especially like the company which might have a good idea, but when the CEO's salary exceeds annual revenue of a company, this is major red flag, at least for me. PayPal, Coinbase, Netflix, ServiceNow, and as you can see, all these companies fell so much, way more than the S&P 500 did. Okay, now let's talk about, I guess, yes, and so speaking about the stock market crash, decline, correction, whatever you want to call it, at least in some individual stocks this did happen, is that only 32 stocks out of entire S&P 500, which is once again the S&P 500, the reason why it is 500, it is because this is the collection of 500 biggest US companies. And only 32 stocks at this very moment, which is once again less than 10%, only these companies are still did not fall as much as the index itself. So, which basically means if the S&P 500 fell from its all-time high, let's say so 2%, 5%, okay, let's make it like 7% to be more realistic. Let's say so the S&P 500 fell 7% from its all-time high. And this graph means that 500 minus 32, it's like 468. It means that 468 companies fell more than 7% from its all-time highs. But at the same time, we see, even though these companies fell 40, 60, some of these companies fell even more than 60%, the index is still relatively kinda resisting the decline, the correction, only down 7%. Because these less than 10% of companies, these are the biggest companies, most of them are the biggest companies, which still keep the index from crashing, let's say so, from crashing. Because as soon as these companies crash, and I'm not expecting Apple to fall 60%. Let's be realistic, I don't see Apple, Microsoft, Facebook, Google falling more than 60%. They might correct maximum 15-20%, honestly, to 30% worst case scenario, which is a lot for companies like this. This is going to be trillions of dollars lost in valuation, but I don't see more than this. As soon as these companies decline, and this is the main point of this live stream, because this is my thesis, why I think that stock market can crash even lower. Because as soon as these less than 10% left of the companies which are still kind of resisting the crash, as soon as they fall, the index will start going down, because that's it. This is the last bastion, this is the last defense of the index against the correction, against the crash, against the recession. As soon as people see that the S&P 500, Dow Jones is also going down 15-20%, this is when real panic will start. And this is when these companies like Peloton, Palantirs, SoFi, I don't know, like all this kind of, no, I don't know, they're not technically garbage, the valuations are garbage. Companies might be okay or good, but the valuations are garbage. This is when these companies, which already have fallen 40, 50, 60%, this is when they fall additional 40, 50, 60%. Which basically means that in the end, we might see the companies like all these cool kids stocks to be down 80 or even 90% down from their all-time highs. Which basically means if right now these companies have a PA ratios of 100, 90% decline, it means that the companies will have like PE ratios of around 10. Which is already something, let's say, so significant, something that makes sense. Maybe it's gonna be too little, maybe it's gonna be too much, who knows, because right now the average S&P 500 PE ratio is like around, what, 25, let's say, so yes? And historically, the S&P 500 PE ratio is somewhere like close to 15, a little bit below 15, which basically means that, yes, as soon as these companies theoretically reach double digits numbers, starting with 1, this is when the markets will correct themselves. And usually corrections are overreacted, which basically means that, let's say, so if the S&P 500 average PE ratio is 15, at the very bottom of the correction of the recession, average PE ratio supposedly be lower than 15 because people will be scared selling everything. And then once again, they'll start buying more and buying more and buying more. So theoretically, we can see all these cool cute stocks to be down as much as 80-90% from their all-time highs, which means that this is just the beginning. Let me get a sip and I'll read your couple of comments. Okay, Jamie Walkerdine. Thanks so much, Jamie, for joining. Thanks so much, Mr. Araya. Okay, Mr. Araya was the first one. Hey, I'm late today. Will we be dollar cost averaging into KWEB? For those of you who are watching later, or if you, Jamie, do not know what is KWEB, KWEB, if you want to call it, this is the Chinese Internet ETF. So, this is the ETF that tracks major internet companies in China, such as Tencent, Alibaba, Vipshop, I think, like all this kind of stuff. Like, it's complicated names, I forgot about them, but you get the idea. Good thing about buying ETF on Chinese companies is that we will speak about DIDI being delisted from New York Stock Exchange soon. But for now, I want to emphasize why it is so good to buy Chinese companies through an ETF. Because whenever you buy Chinese companies through an ETF, the fund has access to all the stock exchanges. And maybe these companies were bought even from Chinese stock exchange, not from New York Stock Exchange. Because previously, last week, it was announced that DIDI, the government wants DIDI, which is Chinese Uber, they want them to be delisted from the New York Stock Exchange, which did happen recently, like Thursday, I think yesterday, it was official. Which basically means that DIDI already preparing the paperwork to be delisted from the New York Stock Exchange, and they will be traded in Hong Kong as soon as possible, let's call it like this, okay? So, there are also other companies that are only listed only on the US stock exchanges, I mean Chinese companies that are only listed on the US stock exchanges, but are not listed still on Chinese stock exchanges. And these are the companies, I will show you the list. One of the slides, it does have a list with these Chinese companies. So I'm thinking that these companies can also follow the example of DIDI, which means that these companies can be delisted as well. And I'm gonna show you this list in a minute. So, and good thing about investing in ETF, that these companies are bought through non-US exchanges, which basically means even though these companies can be delisted from the New York Stock Exchange, from Nasdaq, they will still be available to be traded because you're having an ETF, which basically means that yes, your price will decline significantly, but eventually it will recover. As soon as the shares will start trading again on another place, other investors will start buying it again. Because the price went down so much just because of the delisting, even though nothing fundamentally changed. And that is why I do not hold any single individual Chinese stock, but instead I do have an ETF. And answering your question, Mr. Araya, no, I do not dollar cost average into Chinese ETF. I bought it only once, unfortunately around $50, so now I'm down like 10% or something like this. But it's only, if I'm not mistaken, 3% of my portfolio, which is obviously not that significant. So 10% decline in 3% of my portfolio, it's overall 0.3% influence on my portfolio overall. So basically I don't even see it. I just bought it, I hold it, I don't dollar cost average on it yet, because so much uncertainty about delistings, about all these kind of things. As soon as everything gets settled, as soon, okay, delist all these companies, I'm okay with this. Then the companies will get listed once again on Shanghai or Hong Kong Stock Exchange or Beijing New One Stock Exchange, and then the share prices will go up. And just when all these companies will be delisted, as soon as all the fear is died down, then I might add a little bit more of this Chinese Internet ETF. And Jamie now says, I never understood the whole OMG so innovative thing. When the company does something that's like a small step up of already existing stuff or just another variant of the existing tech. LOL. I know, right? So some companies are truly innovative and like next gen or whatever, trying to solve real world problems. But some companies come on, like Peloton. Peloton is the company which is like literally combined iPad and bike. This is nothing innovative, it just makes it more convenient. Why people were thinking that this can be the company worth $400 billion? This is just This is just stupid, to say the least. And also says that that graph really puts things into perspective. So basically, you know what I'm talking about. Now Jamie says, I figure if China delists its best companies, then there's no point in buying from another exchange, because I take it as a sign China really doesn't want foreign investments and will sabotage them. They do not want foreign investments yet, but what they do not want even more is that their companies will be listed somewhere else except China. Because as soon as they are listed in China, that's basically it. This means that that's it. Like you cannot stop investing from abroad. So if you want your economy to advance, if you want your companies to progress, if you want companies to become bigger, more influential, grow the economy of China overall, there is no way you can stop from being from getting international investments. But I'm most likely sure that as soon as all the companies are at least traded in China at home, this will make them at least to be calm, okay? So right now, there is no possible way for the Americans to influence the stock price with their media or whatever. Right now, we're all good. At least everything is at home, everything is under control. Okay, let's speed up a little bit, and I will show you now Chinese stocks. And these are potential homecoming kings, the one that I was talking about. So DIDI already getting the paperwork done to be delisted, and these are the companies of Chinese big giant companies that are only listed in US and not in China, which basically means these are the candidates for the next delisting. These are the companies you should definitely be extremely careful about if you have them, which is Pinduoduo, NIO is the electric cars basically, DIDI, which already is happening, Key Holdings, and Lufax Holdings. I only know about NIO and DIDI. I heard about Pinduoduo. I don't remember exactly what this company is doing. But these are the companies which have the potential to be delisted following the DIDI example of a martyr. Okay, next slide. So be careful, obviously, once again. Next slide, let's look at this one. The S&P 500 sector returns over 1 week and year to date. So as you can see, and this is the slide from beginning of this week. So right now it's even lower, let's say so. But according to last week, the sectors were as following. Consumer discretionary fell 3.5%, communication services fell 3.3%, technology 3.2%, industrials 2.4%, materials 2.2%, while the S&P 500 only fell 2.2%. Utilities 0.9%, real estate 0.9%, healthcare 0.8%, financials 0.6%, consumer staples 0.2%, and the only sector which did not fall, was the energy, which went up by 1.7%. And this is the performance of year to date of the sectors, which once again the same for energy, it's up 52.8%, real estate 33.7%, financials 33.5%, technology up 28%, consumer discretionary up 24.5%, S&P 500 is up as a whole 23.9%, communication services up 20.9%, materials up 20.6%, industrials up 17.7%. I'm just doing this for those people who do not watch me, but listen to me. Okay, so healthcare is up 17.6%, consumer staples 9.9%, and finally utilities up 8.9%. So we are still relatively good, but once again, this is the sectors as a whole. And you already can see that there is nothing crazy like it used to be, like some sectors were up 100% plus or whatever it was. Okay, so the next slide will be let's take a look at this one. Okay, and this is the one that I showed you, the S&P 500. Now this is with the Nasdaq 100, which basically means 100 biggest technological companies. And so, right, I know that the numbers are very small, so just trust me on this one, or if you want, whenever the recording is uploaded, just pause the video and magnify, make it bigger so you can see the numbers, make it full screen. But long story short, what it says is that from Nasdaq 100, which is once again 100 biggest technological, biopharmaceuticals, all these kind of companies. From these 100 companies, only 17% Okay, so let me see once again. I think that yes, only 17% of companies, which is 17 companies, are the ones which did not fall as much as the Nasdaq 100 index as a whole, which basically means that 83 companies out of Nasdaq 100 fell more than Nasdaq 100 itself as an index as a whole. Which basically, once again, means that these 17 companies are the last bastion which are holding this index to be like relatively flat or not declining as much, at least for now. Okay, couple more slides. So this is the insider sales. As you can see, in 2020 and 2021, insiders were selling so much of their stocks. Why? Because the prices are crazy high. If you open the S&P 500 right now, which we might do as well, why not? S&P 500, let's put 5 years. As you can see, the S&P 500 right now is not at all-time high, but very close to be its all-time high, as you can see. So, and insiders are seeing this. Okay, so our companies, our shares are so expensive right now. The valuations are incredibly stupid, crazy high. Let's just sell it. Let's just lock in the profits, because they're insiders after all. They know that if something bad is happening with the company in the nearest future, they're the ones who know it first of all. If something good is happening, they know it first of all. And they know that, okay, the prices are extremely high for our shares. The company is not doing anything significantly much better. So the valuations are just stupid high. Let's just sell it. Let's just sell our shares while we can, while the prices are so expensive. And this is what you can see in 2020 and 2021. These were the biggest insider sales, literally as long as this graph goes, which basically means as high as 8 years ago. And by the way, in 2021, the insider sales as for now reached $69 billion. So, which basically means they just sell because everything is so expensive. And the last slide, which is gonna be this one, we're gonna show about that some people think that STONKS never fall. STONKS never fall, they said. What they forget about is that from 2000 and all the way until 2010, which is 10 years of stock market performance, my face covers a little bit, but you can still see it. So in 10 years, if you invested in September 2000, all the way until September 2010, if you invested in the S&P 500 or in Nasdaq, for example, if you invested in the S&P 500, in 10 years, you will be down 15%. Imagine this. You invested $100,000 in the stock market in September 2000. And in 2010, 10 years later, whole decade, you might have had kids at this time, you might have sent them to school, and your $100,000 became $85,000. This is if you invested in the S&P 500. If you invested in the Nasdaq 100, $100,000. 10 years later, it became $45,000. So in 10 years, you lost more than half of your investments. So this is for the people who think that, oh, stocks only go up. Elon Musk tweeted something. Elon Musk is buying Dogecoin. Dogecoin is the future. How is it possible that stocks go down? Let's buy the dip. Apes strong, to the moon. No. This does not happen. You cannot go against macroeconomics, you cannot go against finance, you cannot go against even simple math. If things are expensive, the first sign of trouble, things will go down. The more expensive things are, the more down they will go. And as you can see right now, valuations are extremely high. Some companies are even higher than in dot-com bubble or whatever. It's all-time high valuations for some of the companies. And this is what we see. Some companies going down as much as 40-60%, which literally means that these companies lost the growth of entire 1 year in literally 2 weeks. Imagine this. You invested in company, let's say, so I don't know, like Peloton, whatever. Let's use this one. Let's continue using this one. You invested in Peloton 1 year ago, and right now, the person who bought Peloton today you will have exactly the same cost basis. You will pay exactly the same dollar amount for shares of Peloton. But this guy who invested this 1 year ago could have invested it literally, like, let's say, not literally, but anywhere else and made money, or not lose at least that much. So this is the importance of not investing in all these hype stocks that all these YouTubers with crazy thumbnails just like mine proving you that this is the next 100x stock, buy this now. If you don't buy this, you're a fool. Don't listen to them. Stop it. Get some help, I want to say to some YouTubers. But okay. Stonks only goes sideways now, says Jamie. And Pete Griswold, what's up? Thanks so much, Pete Griswold. So, what a Friday, damn, I know, right? So, and so, supposed timelines. So for me personally, this is the last thing before I finish because I'm already 10 minutes late. So, right now, 80% of the market is already down 10, 15, 20, 40, 60, 80%. The reason why the stock market itself is not down 50% is because of like literally 20% of companies. As soon as they go down, which in my just rough estimation can happen, let's say, soon, half year from now, because it will take 4 months for us to stop printing money and then couple more months for the Federal Reserve to increase the interest rates. So I think, this is just my guess, because it's so far into the future, it's very hard to predict accurately right now. My guess that 6 months from now, we can see even lower stock market valuation, which basically means right now the S&P 500 is around 4,500. I think, personally, 6 months from now, we can get lower than 4,300. During these 6 months, the S&P 500 will go up and down 100, like, I mean 1,000, like 100, I mean 100, not 1,000, come on. So during these 6 months, it will be from 4,700, then back to 4,400, then back to 4,500. It will be relatively sideways, I think, because so much uncertainty. Maybe there will be a huge spike close to 5,000, but I think 6 months from now, we will get back to 4,300, and this is when algorithms will take place, and this is when something major can start happening. Okay, so Pete Griswold, love you, bro. Thank you so much. I love you too, buddy. So this is my Friday beer. I hope you had good investing week. I hope you didn't lose as much money. Let me put big screen on myself while I'm saying goodbye to you all. And this is my Mr. Stalin, who always helps me with my stock picks. So thanks so much for joining. Hopefully, one last question from Pete Griswold. So should I save for in 6 months? Just dollar cost average. You don't know. This might happen. This might not happen. I will continue dollar cost averaging, but I will not increase the amount of money I'm investing every single month. I will increase the amount for the next couple of months, because right now the stocks are pretty down. But after this, after let's say so January, February, I will always be depositing the same amount of money, no more, because it's going to be huge uncertainty. So yes, Pete Griswold, hopefully this answers your question. Thanks so much. This is beer for you all. Thanks so much for watching. Pete Griswold, Jamie Walkerdine, Mr. Araya. I know you all. Thank you so much for joining every single one of my live streams. It's been a pleasure live streaming for you. And see you next Friday. Thank you so much. Have a good weekend.